Hi and Assalamualaikum. I'm Nur Shahada binti Zainal, and today my friends and I will be presenting for the topics audit of the inventory and warehousing. Before we move further, let me explain to you about inventory and warehousing. Inventory is a unique account. It has close relationship with other transaction cycle such as sales and purchasing. It is also a complex account and it's time consuming to audit for manufacturing and retail company, which inventory is the largest account on the balance sheet. And then, inventory items are offered in different locations where making physical control and counting difficult. Not only that, diverse inventory items are often different for auditor to observe and value. And the last one, valuation is difficult when estimation of inventory and inventory have several acceptable methods. Next, let's look at the classes of transaction, and we have 4 classes overall in inventory and warehousing. The first one is bank or cash account, second creditor account, third inventory account, and fourth purchase account. Bank or cash account is to make payments. Creditor account is to record the invoice from vendor. Inventory account is to record in or out inventory, and purchase account is to record the amount of raw material being purchased. Here we have A assertion, which is existence, completeness, right and obligation, accuracy, classification, cut-off, realizable value, and the last one is detail tie-in.
The first addition is existence. What is existence? Inventory show on the balance sheet is physically present on the balance date. Next, the audit objective of existence is to verify that inventory included that has been counted using tax existence on the balance date. The classes of transaction and relevant account in existence is inventory account, the relevant account, sale account, receivable account, manufacturing operation account, purchase account, and payable account. The internal control of existence, proper segregation of duty and physical safeguards of inventory to prevent fictitious inventory. Number 2, use properly approved receivable report and material requisition for inventory transfer. And lastly, internal verification by qualified and biased individual and depend on relevant documentation and records from the physical inventory count. The audit procedure. We have 2 types of audit procedure. Number 1, test of control, and number 2 is substantive test. For test of control, need to examine the transfer of inventory from one location to another. Second, examine the pre-number documents for authorizing movement of inventory. Next, we need to observing the physical inventory count between the employee. Lastly, we need to conduct physical inventory count between the employee. Furthermore, for the substantive test, we will check the description and date of all record transfer. Next, compare the tag numbers with the number attached to the actual inventory. And the last one, check whether the inventory is actually exists. The audit evidence. There are evidence to determine the existence. The physical inventory, human resource record, traditional and system documents record, inventory journal, and inventory transaction file. The possible misstatement. There are 2 situations of misstatement. First, overstatement in inventory account of current asset. Next, understatement in inventory account of current asset.
I will explain about the completeness management assertion. The audit objectives are to ensure the existing inventory is counted and tagged, and tags are accounted for to make sure none are missing. Another objective would be to check whether all purchases are recorded completely or not. Class of transaction and related accounts would be inventory account, raw material account, finished good account, purchase account, receivable account, and payable account. The internal controls for the clients would be the bank reconciliation, cash disbursement records, and custody of assets are prepared monthly by the employees independently. Examine the raw material storage area to determine whether the inventory is protected from the theft or any misuse. And then, purchase requisition, purchase order, receiving report, and vouchers are pre-numbered and accounted for. Audit procedure. We have test of control. In test of control, we could inquire as to inventory in other locations, observe whether all the movement of inventory takes place during the count, examine inventory to make sure everything is tagged, account for all used and unused tags to make sure none are omitted or lost, record the tag numbers for those used and unused for subsequent follow-up. Another audit procedure would be substantive tests. It includes from inventory tags to the inventory listing schedules and make sure all tags are included. Account for unused tag numbers shown in the auditor's documentation to make sure no tags have been added, and then account for tag numbers to make sure none have been deleted. For audit evidence related to this would be requisition purchase, purchase order, bank reconciliation, vendor's invoice, receiving report, and perpetual inventory master file. For the possible misstatement, it would be overstatement or understatement of inventory and cost of goods sold. And then it's also misstatement of cash disbursement.
I'm Alia Hani and I will present rights and obligations in the inventory warehousing cycle. For audit objectives under rights and obligations is to confirm all inventory reported on financial statement as at the reporting date held by the company. Also to check whether all the inventories reported in the financial statements represents rights and obligations of the client. Lastly, the client has right to inventory recorded on tax. For classes of transactions and relevant account are vendors invoices, purchase account, payable account, requisitions account, and costing inventories record. For internal control, under control procedure is to recorded inventory is supported by suppliers invoices and goods received notes. Next is audit procedure. There is test of control and substantive test. Under test of control is to check recorded inventory against suppliers invoices and good received notes. And for substantive test is to review consignment or customer inventory included on client's premises. This is to ensure that consigned inventory is not included in the company's inventory balances. Also to inspect purchase contracts, consignments agreements, and vendor invoices to confirm that the company holds legal title to the inventory. Moreover, there are 6 types of audit evidence, that is vendor's invoice, perpetual inventory master files, physical inventory master file, cost of accounting records, good received notes, and supplier's invoice. Lastly, possible misstatements under rights and obligations, overstatement or understatement of inventory and cost of goods sold.
I will explain on the first session on the audit of the inventory and warehousing cycle. The audit objective is to check whether the management are using the correct price to value the inventory and to obtain documentation that an adequate physical examination was made. For the classes of transaction and relevant account, firstly, raw material perpetual to master file account, second, vendor invoice, third, manufacturing account, fourth, finished good account, and lastly, costing inventory records. For the internal control that must be taken out on audit of the inventory warehousing cycle, firstly, appropriate method must be used when evaluating in accordance to accounting standards. Secondly, observes the client counting procedures. Third, make inquiries of client personnel about the counting procedures. Fourth, apply the method consistently. And lastly, consider cost versus market value. For the test of control, first, in evaluating and observing client procedures, include the test count on the inventory and drawing conclusion. Second, verification of inventory by confirmation with the custodian. Third, auditor make an independent reconciliation count with perpetual inventory master files. On the management assertion deal with whether the inventory have been included in the financial statement at appropriate amount. Substantive test, the auditor will determine the inventory valuation method. Second, compare physical count with perpetual master file. And third, record client count for any subsequent testing. Next, the possible statement. First, overstatement or understatement of unit cost, which may affect inventory and cost of goods sold. Second, over or understatement of inventory. Third, Inventory is inaccurately recorded by the custodian if no supervision are presented. Lastly, audit evidence. It means reconciliation of the document, perpetual inventory master files, receiving report, and lastly, cost of accounting record. I will discuss on the fifth accession, which are classification. For the management accession, all inventories are correctly classified on the tag. The audit objective is to check whether all inventories are correctly by their management. For the classes of transaction and relevant account are: first, cost of goods sold, sales return, account payable, inventory bookkeeping, account receivable, and lastly, inventory cash account. Internal control for this accession are raw material requisition and finished goods perpetual inventory master file are used to classify inventory into raw material, work in progress, and finished goods. Test of control. First, examine inventory descriptions on the tags and compare with the actual inventory for raw material, work in process, and finished goods. Second, evaluate whether the percent of completion recorded on the tags for work in process is reasonable. For the substantive control, first, check that the classification of inventory is in compliance with accounting standard and company accounting policies. Second, evaluate whether the percent of completion recorded on the tags for work in process is reasonable. On the other hand, audit evidence is based on inventory journal, perpetual inventory master files, inventory transaction file, and supplier invoice. Lastly, possible misstatements, which are misstatement in inventory records, inventory are wrongly classified.
Now, I will explain about the cut-off assertion. What is cut-off assertion? The cut-off assertion is used to determine whether the transaction recorded have been recorded in the appropriate accounting period. Payroll and inventory balance are often checked for the cut-off accuracy to determine the activity that took place was recorded in the appropriate period. Next is audit objective. Its objective to ensure all transactions related to the inventory must be recorded in the proper period. For example, sales and purchase inventory recorded at the right time. Next is the class of transaction and relevant account. First, payable account to complete payment of the inventory. Second, cash and bank account is a ledger and which of cash and bank transaction recorded. Third, receivable account to ensure their company receive payment for goods and service recorded to this transaction accordingly. Final, inventory account to record in or out inventory. This is another class of transaction and relevant account, which is raw material account, direct labor account, finished good, manufacturing, and purchase account. Now, it is about internal control of cut-off assertion. For management, all receiving report and delivery note should be processed daily, and all employer contribution for the year have been properly recorded even if received in the subsequent year. Audit procedure of cut-off assertion. For the test of control is the examine procedure manual and observe whether unrecorded vendors invoice exist on inventory. For substantive test, record in working paper for subsequent follow-up the last shipping document number used at the end of the year, and select sample of goods received not from immediate prior to the year end and ensure that the goods are included in the year-end inventories. Last part of the cut-off assertion is audit evidence and possible misstatement. For audit evidence, there are cost accounting period and perpetual inventory master files. And for possible misstatement, is from improper sales and inventory purchases and unrecorded inventory.
Realizable value. The definition of realizable value is obsolete and unusable inventory items are excluded. The audit objective is to check whether there are inventories items that are obsolete and unusable. There are two classes of transaction and relevant account, which is requisition document and account payables. For internal control, inventory management personnel review inventory for obsolete, slow-moving or excess quantities, and periodic or annual comparison of goods on hand with perpetual inventory records. In the audit procedure, we have two tests, which is test of control and substantive test. For the test of control, this test is actually for obsolete inventory by inquiry of factory employees and management. This test have a discussion with management and test procedure for identifying obsolete, slow-moving items. And then, this test include review inventory items where it must be present at fair value in the financial statement. For the substantive test, during the inventory count, this test identify quantity of damaged goods and able to alert if items that are damaged must be dust covered or located in the inappropriate place. Next, let's look at the audit evidence and possible misstatement in realizable value. For audit evidence, we have raw materials perpetual inventory master file, cost inventory record, and the last one is physical inventory. For possible misstatement that may involve in the assertion is recording the obsolete and unusable inventory items.
I will talk about the detailed tie-in that is related to inventory and warehousing cycle. First, we have management assertions. Management has to make sure they correctly record their inventories in the inventory listing schedule that agrees with their physical inventory count where the extensions are correct. They also have to correctly record the total amount of inventory that is correctly added and agrees with the amount in the general ledger. Next is the audit objective. The objective is to check whether the inventory recorded is correct with the total amount in the general ledger. The third one is class of transactions and relevant account. There are 6 classes of transactions and relevant account in this cycle, which are vendor invoice, costing inventories record, stock confirmation issue, stock transfer issue, stocks transfer receipt, and stock requisition. Moving on is the internal control. Management has to follow the inventory listing schedule for raw material, work in process, and finished goods in the account balance that agrees with the total. Other than that, management has to ensure that they record the shipment and the receipts that are printed during their physical counts of their inventory. The fifth detail is possible misstatement. For possible misstatement, it could be an understatement or overstatement of inventory and cost of goods sold. Last but not least is the audit procedures. There are 2 categories of audit procedures in this cycle, which are substantive tests and audit evidence. Substantive test is where they investigate the inventory listing schedule and compare it with the actual in the general ledger to detect errors. Meanwhile, audit evidence includes physical inventory, purchase, vendor invoice, stock requisition, and inventory listing schedule.